Well, we wish you well in Copenhagen. Nobuo Tanaka, the executive director of the International Energy Agency, joined us first on CNBC. Thanks very much for being with us. And joining us now for some strategy as we look at all of that and look at everything that's going around the world, Emily Sanders, the CEO of Sanders Financial Management. Also still with us is our guest host, Nick Parsons, who, of course, is the head of strategy at National Australia Bank. Emily, we have a situation here where the U.S. stock market is up, the Chinese stock market is up, gold is up, commodities are up. What's going to drop first? These all don't generally correlate as much as they have been. What's going on?
Yes, Scott. 2010 is going to be the year of dodging the bursting bubbles. And as you mentioned, there are at least 4 of them forming. China, has a very high real estate market right now and a stock market. The U.S. stock market is up almost 70% from the lows of March 9th. And then, as we know, gold until about last week had been going parabolic, not to mention commodities, which are trading up, in inverse relation to the U.S. dollar. So it's really hard to say what would set off the bubbles bursting or if they would all, burst in succession. But assets are more correlated than they have been in the last 50 years. So clearly, something will have to give, and it may be the U.S. stock market first.
And why is that? Why would the U.S. stock market be in the most danger here?
Well, the U.S. stock market is pricing in 25% increase in earnings next year. And what happened in 2009 is that all the costs were wrung out of corporations, by the management, and even on flat or down revenues, profits were up. It's highly unlikely with 2% increase in GDP projections that earnings can go up 25% next year. So we feel like the market is overbought and is due for about a 10 to 15% correction.
Nick, are we in those 4 bubbles, in particular this US stock market bubble?
Well, it's certainly a risk, but I think when we look at the correlation across asset classes, we can explain some of that very unusually high correlation simply by virtue of the extreme uncertainty that surrounds the fortunes for the global economy in 2010. After all, half the investors we speak to are terrified about deflation and are protecting themselves by buying fixed income, and the other half are terrified about inflation and are trying to buy physical assets, industrial metals producers, base and precious metals themselves. So we've got such a diversity of views and such an increasing amount of uncertainty for the global economic outlook that paradoxically it's that's meant we've got these very high correlations, that we've got bonds going up and we've got precious metals going up. I don't think they can all go up sustainably forever, but I would find it very difficult to call.
But the crack is going to come when we get a change in stimulus, when we get a change in monetary policy, isn't it?
When we start to change monetary policy, and that really is going to be the challenge for the monetary authorities worldwide, because the danger, the first Fed move will inevitably prompt concerns about the next 16 that are going to come, because last time they did it, there were 17 rate hikes. They're going to have to manage that process extremely carefully.
How will that play for you? Emily?
You're talking to me, Ross? Yes. Oh, yes. Well, 2010, again, is going to be the year of the great handoff. And it's going to be the handoff from coordinated government stimulus throughout the world back into the hands of the consumer and market forces. And right now, the market, at least in the U.S., has been going up on extremely low volume. And also, the unemployment situation, at 10%, is hardly anything to celebrate or cheer about. Just because unemployment dropped from 10.2 to 10%, we'd have to have 100,000 new jobs created every month just to keep unemployment steady at 10%. So it's our forecast that next year unemployment could go as high as 11% before it starts coming back down to more normal levels. And that's hardly sanguine for consumers to start really spending again at the levels that they were, unless the Chinese consumers take over due to their high stimulus that the Chinese government is doling out, and may even come up with a second stimulus in 2010. But that could lead, to more bubbles. It's really too soon to tell. However, the deficit is just, going up, $1 trillion of new borrowing a year, and as rates start to go up in the U.S., there's the other factor of the debt burden, the interest expense for the U.S. government getting higher. So it's sort of like a conundrum because rates do need to go up, but the deficit is nowhere in sight of getting solved. The White House projects that by 2019, there's going to be $700 billion a year just of interest paid on government debt.
So we are in what is a very, very interesting transition here. You talk about the handoff and also people coming back into the workforce, and we're going to keep up with that. Emily, I know you're going to be with us for the rest of the hour, as will Nick Parsons. Emily is with us, and Nick as well, and still to come on Worldwide Exchange. Tiger not out of the woods yet. This weekend, the golfer lost his first endorsement after details. Coming up on 5 minutes before the top of the hour, for more on the trading day and the week ahead in the U.S., we bring back Emily Sanders, CEO of Sanders Financial Management. You talk about, Emily, the big handoff that basically is the move from government stimulus and all of this government support back to the private sector taking control here. And we're going to get some indication when the Fed meets this week, not necessarily from any actual action in monetary policy, but the statement. What should we be listening for?
Scott, we expect more of the same from the Fed this Wednesday when they make their statement, keeping short-term rates at 0 to 25 basis points. There really is no impetus right now for the Fed to start raising rates like some other smaller economies have done, such as Canada, Australia, Israel. We expect that by the second or third quarter of 2010, we will start to see the Fed increasing rates. Don't know if it'll be 17 times like Nick alluded to, but certainly the gradualist approach, 25 basis points at a time. And when
Emily,
that happens, the consumer
we're going to have to leave it there. Thank you very much. You've been watching Worldwide Exchange on CNBC. For all of us, have a good and profitable trading day.